Valens Research, Uniform Financial Analytics.
Marriott is really interesting because of the fact that this company has actually been massively improving, but as reported metrics make it look like that's the opposite of what's been going on for this business. This is what's really important when you try to understand and decide whether or not you're going to look at a business, right? A lot of what it is, right, if you're a growth investor, it's about, are you seeing fundamental momentum in the business? If you're a value investor, you're trying to understand, hey, are you seeing a business that's declining and has low valuations? Which means if it's declining and has low valuations, well, that might be because it's a broken down business. If it's improving and has low valuations, that's a phenomenal buying opportunity. But if you don't actually understand the real return trends of the business, it's not just about level of returns, but where returns are going. You completely misunderstand what you should think about how good this company is and therefore what it should be worth. Marriott's an excellent example of this, right? Not only are current as reported ROAs massively understating the profitability of this business, right, with a 7% ROA, when the reality is this company has 100% plus ROA, they're misunderstanding the trend of this company's profitability. Right? When you look at Marriott, most of you probably know Marriott is now not really an owner of hotels anymore. For the most part, Marriott doesn't own hotels. Marriott operates hotels. Someone else owns the hotel and then licenses the Marriott brand, one of the various brands, from all of these Starwood brands, from Westin to the W to the St. Regis, or one of the classic Marriott brands like Ritz-Carlton, Marriott, Courtyard, Renaissance, etc., license those brands and then lets Marriott operate the business. Well, all that they do is basically own and maintain the hotel itself. What we'd assume is that a company like that should have expanding ROAs, right? As you get more and more asset light, as you invest less, but have more return because the fact that you're building more, because other people are building more and more hotels for you, you'd expect returns to expand, right? Just intuitively, right? More hotels means more revenue. If you're not having to invest in those hotels, more revenue means more drop down take, if you will, for Marriott, which should mean a higher return. But you'd be concerned if you were in a investor looking at as reported accounting metrics, because what you'd see isn't a company with rising returns. You'd see companies whose returns fell from 7% in 2015 to basically 7%, sorry, not 7%, 13% in 2015, down to 7% today. You'd see a company whose business model was broken. They had an innovative strategy and that strategy isn't working. In reality, once you see through the accounting noise, once you make the correct adjustments for the Starwood acquisition, once you look at what's really going on with the balance sheet and what's really going on with the income statement, you see this has actually been a phenomenally successful strategy for the business. There's a reason why this company has performed so well over the last couple of years, and the reason why is because returns have been massively ramping. This company has gotten asset light, and when it's gotten asset light, it's seen returns shoot higher because of the fact that its strategy is correct. Now, the other side of the business is, though, unfortunately, even with the recent sell-off for the company, the market already is still pricing that in. Right at current valuations for Marriott, the market is saying, hey, you're going to continue to modestly shrink, but also you're going to continue to see returns expand going forward as you get more and more hotels opening on your platform. And right, so that says, hey, even though Marriott stock has fallen a lot, Marriott actually isn't cheap because of the fact the market still actually gets what's going on for Marriott. But more importantly, you wouldn't even be able to have that conversation and say, hey, does the market know the company is actually improving its business if you were looking at the as reported metrics, because you wouldn't even think that the business's profitability was improving, right? You would think that this was a declining business when it's anything but.
Valens Research, the world's leading source for uniform financial analytics.